Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates, and I will begin as I always do by saying thank you. Thank you for taking the time to listen today, and thank you for your service to our country, to me, to everybody. You do not hear that enough. You will always hear it here. I'm happy to report once again, I'm sure will be no surprise to our regular listeners, that Ed Zurndorfer is back with us. Yes, the guru is here as part of our ongoing mission to reach, teach, and serve you. Now, at the outset, I do need to say that the opinions of our guest, Ed Zurndorfer, although I think they are awesome, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at stwserve.com. We will help you any way we can. Once again, we will follow Ed's FedZone articles to give us one more way to reach and teach. But wait, there is still even one more way to learn from Ed, and that is the weekly serving. Every week, we deliver the best of Ed, Jen Meyer, Benefits Ben, occasionally yours truly, right to your inbox. So don't miss out. See our subscription information on your YouTube page for this podcast. Well, Ed, we are all Secure 2.0 all the time today.
Fantastic.
Ed, is it safe to say that most folks may not realize everything that's in this bill?
Yes, that is quite true, Dan. There's a lot of stuff in this bill, some of which took effect on January 1st, 2023. Other parts of the bill are going to take effect in future years. But yeah, that's a very safe statement. It's a true statement. Most people do not know everything that's in that Secure 2.0, the Secure Act 2.0 that was passed on December 30th, 2022. President signed it, and it took effect for many of the provisions on January 1st, 2023. Gotcha.
And so, Ed, take us away, because I see from your article, there's actually 92 provisions in here designed to increase America's retirement savings. So let's dig into the meat. What are the rules regarding RMDs for TSP and traditional IRA? Because that's what you kick off in your article.
Okay, just to review here what an RMD is. RMD stands for a required minimum distribution, and what that means is that when a traditional IRA owner and a qualified retirement plan owner, what's a qualified retirement plan? It's a 401k plan, it's a 403b plan. Is it the thrift savings plan? Actually, Dan, I don't know if you're aware of this, the TSP is not classified as a qualified retirement plan.
Really?
It has many of the aspects of a qualified retirement plan, some of the rules, but when the TSP was set up back in 1987, they did not adopt all the rules of a qualified retirement plan. And let me just give you one example, Dan. One simple example why the TSP is not a qualified retirement plan. The qualified retirement plans, 401k plans, 403b plans, were established under what was called ERISA, E-R-I-S-A, back in 1974. And one of the provisions of ERISA that applies to qualified retirement plans is the fact that if a individual is participating in a qualified retirement plan, like a 401k plan, the beneficiary of that plan has to be his spouse. Has to be. It is a requirement that if a person is married and puts $1 into that 401k plan, automatically the spouse will be the beneficiary. The beneficiary form doesn't even have to be, the spouse doesn't even have to be designated as beneficiary as a beneficiary of that 401k plan. Whereas with the TSP, that is not the case. You can name anybody as a beneficiary of your TSP. logically speaking, it should be your spouse, but it does not have to be. See the difference?
Gotcha.
But both the TSP has, of course, adopted the RMD rules that when a federal employee who has contributed to the TSP during his or her federal career reaches what's called the required beginning date, and we're going to review what that required beginning date is here in a few moments.
Right.
Then, and they are retired from federal service, they must each year take what's called a required minimum distribution. And the same thing is true with the TSP. Now, before the passage of Secure Act 2.0, which was before the passage of Secure Act 1.0, which took effect on January 1st, 2020, the required beginning date for a qualified retirement plan participant or TSP participant or a traditional IRA participant was April 1st following the year that the individual turned 70 and a half.
Gotcha.
70 and a half. When Secure Act 1.0 was passed, effective January 1st, 2020, if an individual was born after June the 30th, 1949, their required beginning date was increased to April 1st following the year he or she turned 72.
Okay.
And then with the passage of Secure Act 2.0, they increased the required beginning date as follows. Somebody born after December 31st, 1950, their required beginning date is April 1st following the year they turned 73. Like myself, I was born in January 1951. So guess what, Dan?
You are 73.
My required beginning date is April 1st following the year I turned 73. And you know something? During 2022, before the passage of Secure Act 2.0, I was getting ready to take my first RMD for my TSP account. I was all set, but they passed it right at the end there. So I get an extra year to take out my first RMD. And it's April 1st, 2024. But we're not done yet, because the required beginning date was increased to age 75.
Yep.
For individuals born after December 31st, 1959. All
Gotcha.
right? So we have in total here, we have 4 different required beginning dates depending on when you were born. Okay.
And folks, I'll remind you to head over to the Fed Zone. That's fed-zone.com, and pull up Ed's article, because he's got an awesome chart in there that's going to make it super clear with that. Now, Ed, as you touch on in your article, relative to the required beginning dates, it could be different for TSP and IRA, especially if somebody's still working, correct?
That is correct. The rule has always been that if you are still working for a company in which you participate in their 401k plan, if you're still in federal service and you reach your required beginning date, you are not required, you don't have to take an RMD while you're still working for the company, you're still in federal service.
Gotcha.
When will be your required beginning date? April 1st, following the year that you retire.
Gotcha.
But you got to be careful here, Dan, because let's say there's somebody working in federal service who's past the required beginning date. Okay. All right. Let's say they were born, let's say, before January 1st, let's say 1950. Okay. Yep. And they're still in federal service. still working.
Gotcha.
In reality, they have passed the required beginning date. They have passed their required beginning date. But they don't have to take their TSP RMD because they're still in federal service. Let's also suppose that that same person has a traditional IRA.
Mm-hmm.
Okay. Even though they don't have to take the TSP RMD, they are required to take their traditional IRA RMD.
Gotcha.
Let's further suppose, Dan, that that same person who's working in federal service past their required beginning date, sometime during their lifetime, they were working for a private company and they put money into the company 401k plan.
Gotcha.
Well, because they have left that company, maybe they retired from that company, they certainly cannot contribute to their 401k plan anymore because they left the company, but they have to take an RMD from the 401k plan. Once again, even they're still in federal service, no TSP RMD, but they have to take a 401k RMD, and they also, because they have a traditional IRA, have a traditional IRA. Now, I want to point out, Dan, that there's a solution to this problem. If anybody listening today is past their required beginning date, they're still in federal service, and they have a traditional IRA, or they formally participated in a qualified retirement plan, the TSP allows TSP participants to directly roll over money from qualified retirement plans into the TSP. They can transfer their traditional IRA into the TSP, and in so doing, once that money goes into the TSP, traditional TSP, no RMD will be required because the money's no longer under the 401k umbrella. It's no longer under the traditional IRA umbrella. It's inside the TSP. It's a planning point. Dan.
Sure. And, like most planning points, folks, the important thing to understand, we're not giving advice here. So this isn't a set it and forget it idea, because that may make sense while you're still working. And then you may want to take a different approach once you're retired. But Ed makes an excellent point there. Now, Ed, I noticed that your article further goes into there are actually some pitfalls to consider with this, and you note 5 possible tax consequences for our feds, and the first one would be bracket creep due to the RMDs, correct?
Yes, Dan. As you know, I have accounting and tax practice, and
Yes, you do.
I am very sensitive to taxes. I tell people, you got to pay your taxes, but there's no reason you have to pay more than you have to in terms of there are ways that you can minimize your tax liability. And one of the things that we have to keep in mind about the RMD is that RMD that you're taking out of, let's say, the TSP or a traditional IRA, will be added. It's taxable. It's going to be added to your income.
Sure.
The larger TSP, traditional IRA, or any other RMDs you have to take from 401k plan, the more taxable income, possibly pushing the TSP participant, traditional IRA owner into a higher federal marginal, or even state, because states tax RMDs too. You may be moving into a higher marginal tax bracket. So we want to make any way possible to minimize our RMD. We should do so. Okay.
Sure.
But Dan, it's not only taxes. It's not only taxes we have to talk about. I call it the tax creep. You're creeping into higher brackets.
Yep.
When an individual turns age 65, they are encouraged. They don't have to enroll in Medicare. Medicare Part A, the hospital insurance, which is free.
Yep.
We also recommend that they enroll in Medicare Part B. It's called the medical insurance. Okay, you don't have to, but it's encouraged. Medicare Part A, as I say, is free. Medicare Part B is not free. You have to pay a monthly premium every year.
Yes,
And
you
the
do.
amount of your monthly premium each year depends on something called your adjusted gross income. The higher your adjusted gross income, the more your monthly premium. What's included in your adjusted gross income? Just about everything. If you're getting, let's say, a CSRS annuity or a FERS annuity, Social Security,
Sure.
traditional TSP, not Roth TSP, not Roth traditional IRAs, not Roth IRAs, but once again, your RMD from the TSP, your RMD from your traditional IRA is fully taxable, added to your income, and the result be it could push you into what's called a higher income tier and be subject to what the Medicare people call income related monthly Medicare monthly adjustment. You're going to be paying more. It's called IRMA. I call it Aunt Irma. Aunt Irma.
That's not fair to
IRMA.
Aunt Irma. Aunt Irma is a lovely lady. This is people getting hit in the wall. Go ahead.
Well, Irma, I'm sure Aunt Irma has one A. This has two A's.
Yes, gotcha.
Okay. Okay. So it's IRMAA.
Gotcha.
Any rate, once again, I get all these complaints. Ed, I got to pay so much for Medicare Part B. I said, well, is there, they say, is there anything I can do to minimize it? Well, yeah. I'm saying, go, spend all your money, but the fact of the matter is that there's that you, if you can minimize that RMD somehow, some ways,
sure,
that could result in you're less likely to be subject to that IRMA.
Gotcha.
We have some strategies. We talk about some strategies, what you could do to minimize your income. One of which is before you reach 65, convert all your traditional IRAs to Roth IRAs.
Sure.
Before you reach 65, if you're retired from federal service, transferring your traditional TSP to a Roth IRA, even though you got to pay the tax. Once you pay the tax, this way, when you take money out of the Roth IRA, it's not going to be included in income. So
sure.
you could end up paying during your lifetime less in Medicare Part B. So that's the second thing. The second thing you got to be that TSP participants have to be traditional IRAs have to be aware of when it comes to larger RMDs.
Sure, and one of the things about that IRMA creep that's different from bracket creep. So if you go $1 into a new tax bracket, you're only paying the higher amount on that $1.
Good point, Dan.
You go $1 over into IRMA, and you could have $100 jump depending upon, which bracket or something like that. So and you're right, Ed, this gets missed a lot.
Dan, if I can make a plug here, I know I always say
plug
this,
away.
Okay.
Absolutely, my friend.
Serving those who serve, we have a monthly webinar entitled FEHB, Medicare and TRICARE, and we talk about Medicare Part B and the need and the cost of it. We talk about these income tiers. We talk about the fact that if you go, like you said, Dan, go over by $1, you could be pushed into a higher income tier and pay more for Medicare Part B. And we make suggestions. We do that during that webinar to minimize the chances of being subject to IRMA. We also talk about it during our TSP webinar that we hold every month.
Yep.
So, ladies and gentlemen, what I'm saying is there's lots and lots of opportunities to not have to pay so much for Medicare Part B, but there's planning. Okay.
Yep. Absolutely. So jump into our next one. A lot of feds might not be familiar with this, but it's certainly out there. And that is the net investment income tax. Tell us about that.
That's an additional tax is equal to 3.8%. That is in addition to your regular tax you're paying. And that's based on you're paying tax on things like dividends and dividends, capital gains, and additional tax, interest income, because you're over a certain income level.
Sure.
If you're a single person, if your AGI is over $200,000, AGI is basically for most people, it's going to be your total income. For married couples, it's 250,000. They're going to impose, the IRS is going to impose a 3.8% tax on your investment income in addition to the regular tax you're paying. For example, let's say you sell a stock, you made a huge profit, a huge profit of let's say $50,000.
Mm-hmm.
Well, you're paying a capital gains tax. Most people pay 15%. So 15% of 50,000 is $7,500. That's the federal tax. In addition to that, when you include the 50,000 and it brings your AGI over, let's say you're a single person of 200,000, you're going to pay another 3.8%. What is that? That's another $1,900 in
Sure.
addition to the $7,500 you're paying because your income's over that level. And once again, RMD is going to add to your adjusted gross income.
Absolutely.
All right. So now we move on to the fourth one.
Well, throw one more thought in here, Ed, because boots on the ground, the experience that I've had meeting with feds, people go, 200,000, that's way up there. It's not that hard to get over that bar, folks. Especially, I'll give you an example, 2 feds, 2 federal pensions, with or without Social Security, depending on their CSRs or FERS. Okay. And then you've taken advantage of deferring, and not having to take money out of TSP or your IRAs or something like that. Well, you get out to 73 or 75, all of a sudden the slices of that pie get bigger and bigger.
That's right.
So you could very easily find yourself in the enviable and unenviable position of clearing that $200,000 threshold. So don't fall victim to the mindset of, that'll never happen to me. I see it all too many times. So yes, now jumping over to number 4, Ed, you point out the higher income from those later RMDs might get folks to phase out for federal and state tax credits. What's going on there?
Dan, I just want to say this. I love tax credits.
Oh, I know you do.
Because they are a dollar for dollar reduction in your tax liability, as opposed to a deduction where if let's say you're getting a $1 deduction and you'd say you're in a 22% tax bracket, that's only saving you 22 cents. Okay.
Sure.
So I love credits.
To deduct is human, to credit is divine.
Good point.
There you go.
One of the problems with many of the tax credits is that if your adjusted gross income is too high, you are not allowed to take that tax credit. Give you an example. Some of the I think the car that now we have with electric cars and things like that. If you're going to be limited if your adjusted gross income is too high.
Sure.
And there are also some state tax credits. I did my first 2022 tax return this week, and a person lives in Virginia, and they have a whole slew of credits there, and all of them say the following: if your Virginia adjusted gross income is too high, you cannot take the credit.
Sure.
So this particular couple lost out on a few credits because their income was too high. So again, we were trying to minimize that RMD to take advantage of federal and state tax credits.
Absolutely, and folks, we're not trying to make this daunting, but we want you to help you understand that there's a lot to watch here. Because on one front, you might be sitting there going, I don't need the money. Fine, let's kick it down the road. No point in paying taxes on it. There's a flip side to that. And now we go into number 5, which is sort of an interesting kind of pivot in what you've written, Ed. And that is where, hey, we've gotten these new RMD rules, so we can delay, possibly as late as 75. And now you're suggesting, and I agree with you, by the way, that somebody might want to strategically take money before those dates. So why might somebody want to strategically withdraw before the required beginning date?
The reason is, Dan, that the way the RMD is calculated, the TSP, let's say a TSP RMD, the TSP is looking at your total account balance. As in a particular year, you're subject to a TSP RMD. So the TSP is going to look back in the previous year, your TSP account balance as of December 31st. And once they have that account balance, they divide the account balance by what's called a life expectancy factor. And the bottom line is that the higher your account balance, the larger is going to be your TSP RMD. By starting to take withdrawals from your TSP before the year you reach RMD, or years before that, by the time that December 31st rolls around for that first year, your account balance will be lower, and therefore your first year RMD will be lower. And now you're going to take in the current year, you're going to take your RMD, so your account balance will go down. And assuming that your TSP is not growing in value tremendously, chances are for future years, your RMD will be decreasing.
Sure.
So now another way, which I did not bring up in the article, I was thinking about it now, is that once they reach 70.5, they can make what's called qualified charitable distributions, QCDs.
Great point.
Take the money, what you would have to do is, because a qualified charitable distribution is nothing more that a distribution comes out of your IRA.
Mm-hmm.
And the IRA will send the money to your favorite charity. Could be church, synagogue, a mosque. It could be the Goodwill. Make a cash donation.
Sure.
And that money that's given, that is sent from the IRA, your IRA, to the charity, will not be included in your income. Can you get a charitable contribution donation? No, you cannot. The main purpose of the QCD is for people to count that QCD as part of their RMD, because the law is that, let's say you have a $10,000 RMD in a particular year, and of course you're over 70.5. Let's say you're that year you have a $10,000 RMD. Well, if that money, if you have $10,000 in your IRA, and that's your traditional IRA, and that traditional IRA is the one we're talking about that's subject to the RMD, the $10,000 goes from your IRA to the charity or charities, because it doesn't have to be just one charities, and that will fulfill your RMD. That's the good news. Now, you will not, there's actually another piece of good news. Normally, when you make a distribution from your IRA, that counts as income. Well, it's not going to, because went to the charity. So what I'm saying is this, that someone who has a sizable TSP account,
sure,
before they reach their required beginning date, they should make a series of transfers, and they can do this. Transfer their traditional TSP to a traditional IRA. That will decrease the amount in their traditional TSP. And then when they reach 70.5, they can start doing these QCDs. How much can they do per year? Under current law, $100,000. You can make up to $100,000 QCD, and all that money going to your favorite charity or charities will not count as income. And by the way, part of Secure Act 2.0, Dan, is that they're going to start indexing that $100,000 limit on QCDs starting next year.
Oh, that's nice. So that's great. Okay, Ed, so your article rounds out with a couple of points, some follow-up information with regard to the increase the RBD and how the increase affects current qualified plans. So why don't you take us through those?
Okay, so assuming a federal annuitant does not have to make any withdrawals from their TSP account or traditional IRA in order to pay monthly expenses, the increase in the required beginning date allows for additional time in which the traditional TSP and traditional IRAs to potentially grow tax deferred. And for the Roth TSP, the increase in the required beginning date allows for additional time for the Roth TSP to potentially grow tax-free. We're going to talk about later, Dan, something great that's going to happen as far as the Roth TSP is concerned starting next year.
Yep.
But right now, I think it's important that those individuals, particularly those who cannot contribute to a Roth IRA because their income's too high, you always are allowed to contribute to the Roth TSP.
Yep.
So as long as you stay in federal service, you're allowed to contribute to the Roth TSP. And with the increase in the required beginning date, that means that you'll be allowed to, in general, make more contributions to the TSP. Okay. As well as traditional IRAs. So your overall retirement savings will grow. Okay.
Gotcha.
Another thing I point out in the article is that those federal employees who are in their 50s and 60s, the increase in the required beginning date may be a reason for employees to continue working in federal service and delaying their retirement from federal service.
Sure.
In so doing, they'll be able to continue contributing more over time to the TSP, resulting in additional TSP savings, potentially grow tax deferred in case of the traditional TSP, in the case of the Roth TSP, tax-free. And as we'll talk about later on, this increase in the Roth TSP is especially important because all money coming out of the Roth TSP tax-free, but as part of Secured Act 2.0, as we'll explain, the Roth TSP balance, your Roth TSP will not, starting January 1st, 2024, be used in the calculation of your TSP RMD. We're going to talk about this.
Oh yeah, that's the next podcast. Don't give it all away now.
I'm not going to give it away now, but this is a tremendous benefit, Dan.
Sure.
Okay. One other thing here, as part of Secure Act 2.0, that those employees ages 60 through 63 will be able to make larger catch-up contributions starting January 1st, 2024.
Sure.
The catch-up contribution limit will increase for employees ages 60 through 63. Those employees who will be 60, 61, 62, 63, those years, they can, let's say, starting in 2024, contribute in catch-up contribution the greater of $10,000. Remember, mind you, this year is $7,500, but starting next year it'll be $10,000, or it's going to be the greater of $10,000 or 150% of the regular catch-up limit, which would be, if you go by the $7,500, that's $11,250.
Oh yeah.
So that means that starting next year, those employees between 60 and 63 can put at least almost $4,000 more into in catch-up contributions to TSP. This is great stuff, great opportunity. But remember, the only way you can contribute to the TSP is while you're in federal service. So if I'm 59 years old now and I'm eligible to retire from federal service, I got more than 30 years of service, you may want to think about hanging in longer, work a few more years, especially till 62 if you're a FERS employee, because in addition to be able to contribute more to the TSP, also you're getting a 10% bonus in your FERS annuity. I'm not going to go into details here, Dan. That's a subject for another webinar.
Absolutely.
But those listeners who want to know more about this, retiring at age 62, 10% bonus in the FERS annuity, please attend one of our monthly FERS webinars.
Absolutely. Absolutely. We keep more people in federal service than retention bonuses. All righty, Ed. Boy, I'll tell you, I say it all the time. I don't know how you keep all this stuff straight, but I am very thankful that you do it on behalf of the federal community and on behalf of Serving Those Who Serve. Folks, there's only one Ed Zurndorfer, and I'm happy to say there's only one Serving Those Who Serve. So you're just not going to get this stuff anywhere else. Well, folks, that is a wrap. And be sure to catch our next podcast. We will still be on Secure 2.0 and what it means for you, but we will be diving into Roth TSP, and also pretty cool thing that's coming down the pipe as far as 529 plans. You don't want to miss that. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Please remember to share it with your friends and neighbors. Check us out on Twitter and LinkedIn. Do not forget our live webinars every single week. As I said before, just go to that SWS website, swserve.com. You will see the blue webinar button that turns red when you hover over it. Click that, and you will see the whole menu come up. That's all Ed. He comes right to you. Reach you where you are, teach you where you are, and serve you where you are. Sign up for one, sign up for all. Share that page with your friends. They will thank you. Don't forget every week in the Fed Zone, at fed-zone.com. And don't forget to sign up for that weekly serving. So, closing out for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I will close as I always do by saying good luck, Godspeed, and above all, remember, it is your FedLife. So make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.